Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View, and today we're talking about really what I would call potpourri. Lots of things. Lots of things. We have lots of topics to talk about. One of the things we're talking about is when an offer is really an offer. Let's talk about, there are a number of job candidates out there who are getting offers, just like there are sellers of houses getting offers. And so a company will negotiate with an employee and they'll make that employee an offer. Many times it's a verbal offer to start out with. And that employee will say, because they want something that's certain, I'll take it. And then lo and behold, as soon as they say, I'll take it, another company comes along with a better deal.
Yeah.
What do you think about that?
Well, I mean, honestly, in their defense, they're trying to do the best job for themselves, and I understand that.
To heck with the company.
Right, and well, it's just part of the deal, but it doesn't generally go the other way in job offers. If you make an offer to an employee and you get a better candidate, you generally don't renege on that offer.
Well, sometimes companies come along and say, we made you that offer, I know, but we're just kidding.
Oh, really? Yeah, it happens, but I don't think it happens as frequently. But it does in housing right now, evidently. There was an article in the New York Times this weekend talking about the really, really intense buying market right now in New York. And the fact that it is very common for a seller to accept an offer verbally, hold that offer, even hold the check, the deposit.
Maybe for 3 or 4 days.
Right.
Not sign it.
Right, and then get a better offer and return the check and take the better offer.
So it's just an option to negotiate.
Exactly.
Basically, it's a real estate form of a derivative.
And what they'll do is they'll go back to the original offer and say, I've got a better offer now, and will you raise your offer? And so it puts people in kind of a bind. It's sort of it's bidding, essentially bidding for the house.
It's just an opening bid. So the first offer, which you verbally accept,
right,
which of course in, I guess, every state, because it's real estate, is not binding.
Right. You've got to have the written signatures. And so I don't know. On the other hand, when the market was coming down, buyers would walk from an offer.
Right.
Too. They would find another house that was cheaper, that was similar, and they would say, just kidding, and move over to that house. So it goes both ways.
Now, when you sign on the dotted line, it's a different deal.
Then you've got a contract, right?
Exactly, it's a
and
problem.
so you're set on that.
Well, economists talk about this market equilibrium, and this is an example of where it's disequilibrium, right?
Well, I think what happens is that anytime you have transition from one kind of market, we've had really bad circumstances, and now things are heating up, there's going to be pockets where things get very hot, right? And
it doesn't stop at that at equilibrium on the graph?
No,
it just goes on by?
The thing about an equilibrium is you can be pretty much guaranteed that that's a point that you're never going to attain. It's always out of equilibrium, and so you get these hot markets, and you get a bidding type of frenzy going on that almost always results in kind of a winner's curse.
Exactly. So you want that house. You absolutely want that house, and so you pay too much.
You do.
But the winner's curse, of course, is you pay too much. Companies. This happens in companies all the time. They pay too much.
Right.
They pay more than the acquired company is worth.
Right, and they get set on it. They get focused on one thing, and they, in the bidding frenzy, you end up paying too much for that. You win the bid.
You get the asset.
Auction.
Yeah, you get the asset.
Right, but you end up paying too much. There was an article out of California this week where California, they've had this kind of a bidding frenzy, but that is now sort of settling down. People are starting to relax a little bit. The markets are not uniform. They're hot places.
They're localized. The market's localized.
Exactly.
And that's been true for real estate markets for a long time. And we're seeing financing rates come down a little bit.
Right. They have dropped off a little bit. They had peaked out. Everybody was, based upon Bernanke's comments, the bond markets went crazy for a while, and the rates went way up. Now that's coming off. They're coming off of that a little bit. There's still about 5 million properties out there which could be refied to the buyers or to the loan owners' advantage right now.
So there's still good demand for refinancing.
Well, potentially good demand. I don't know if you're going to be realized or not, but there are people who could be benefit by refi, and a significant number, about 5 million that are out there.
Well, there have been some new rules put in. The CFPB, Consumer Financial Protection Bureau, has put some new rules in on disclosures. There's been a huge move to try to get consumers to move to electronic disclosures.
Yeah, and I think that's going to really happen. The head of mortgage for Chase this weekend was talking in an article and said that this new electronic app that they have created, they've had about 250,000 people download that already, and it's only been out a short time.
Which is good.
Yes, and the other thing they said is that in their mortgage applications, they're moving to asking people to sign everything electronically, do their disclosures.
Getting the right to disclose electronically right up front is a big deal.
Right.
It saves the institution, a lot of money.
Yeah, it's a great thing. It's a very big convenience for the customer. And about 80% of their applicants are agreeing to do that, which I thought was a phenomenal number.
It is a phenomenal number. So for our listeners out there, the disclosure of the different mortgage documents can occur in multiple ways, one of which is electronically, but the applicant has to acquiesce to that right up front.
Right.
And it's a big deal because it saves the institution, they don't have the printing cost, the mailing cost, that sort of thing, of all those documents, and which can be significant.
Right, and file storage is a big issue, and maintaining copies of all that. And if you've got paper, and it's a mess, and so...
And a lot of those documents, there are multiple versions of those documents.
Right.
So there may have to be multiple disclosures.
Exactly.
Depending on the situation.
Yeah, and so the ability to do that electronically is a big advantage. I don't know how the market is going to change over time, but I think that the move to electronic is inevitable. I mean, people are becoming more sophisticated, and so that's going to continue to happen. In terms of these markets, individual pockets of markets, whether hot or cold or something like that, that's going to, I think it's just going to take a long time before the markets are going to be able to come back to some sort of a equilibrium.
Well, there was so much disruption, and let's lastly today talk about foreclosures and what we're seeing in terms of shadow inventory coming on the market from foreclosures, short sales, that sort of thing. Obviously the rate of foreclosures has declined.
Yeah, it's gone way down. And a lot of these institutions were criticized because they weren't dealing with borrowers in financial bad situations, because frankly they were overwhelmed.
Right.
And so they scaled up, trying to catch up with all this foreclosure mess. Now the foreclosures have come way down, but they have got their act together in terms of managing all of that.
Right.
And so actually now, if someone gets in a problem, they're much better able to handle that and respond to that. So they're being processed very quickly, and so moving that through the system
in fact, to that point, many of the big banks are reducing their capacity, their servicing capacity, their servicing or delinquent processing capacity, because they've got too many people. They've ramped up and gotten too big, and because the volume is coming down, they're downsizing. I think they would say right sizing. They're downsizing their operations because they can handle these so efficiently.
All right. And to the point you were making about the inventory, one of the problems was that with all of the uncertainty about the financial markets and the high levels of unemployment, people weren't moving, they weren't buying new houses. And so what was happening is that you just didn't have a lot of inventory. And so when you had a market start heating up, there just wasn't any supply available. And so that's why you got these accelerated price increases. The existing home sales numbers are coming out today, and consensus is somewhere around 5 million at a seasonally adjusted annual rate. That's going to stay that way now probably for quite a while. Refis are coming down, purchases are going up, but slowly.
Right.
And so there's going to be a overall decline in new loans probably for another year, you know. And then purchases are going to start picking up and start catching up and making up some of that.
Well, Dr. Dorsey, we're out of time. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week.